Hello, everyone. I'm John Humphreys. I'm the Executive Director of the Association for Equity and Funding. I'm pleased to have our friends from PMA back with us, Matt and Kendra, to talk about a market update. This has been a nice series for our group in particular. Some of our districts are small enough that they don't have business managers. So superintendents are getting critical information from the folks at PMA. We certainly appreciate it. It's always interesting to hear. And we've weathered a couple of kind of interesting storms here in the last year or so, Matt. Last time I was looking back at our slides, we were talking about some bank failures. That crisis was contained, and things have continued to move forward with banking and market changes and interest rate changes and all that good stuff. So it'll be fun to hear what you guys have to share today. I will say this, I was talking with a colleague earlier today, and I said, are you going to be able to dial in for Matt later today? He said, no, I'm really bummed. The guy's brilliant. So we got that going for us.
All right, I appreciate that and the kind words. With me today, as you said, I have Kendra Shelland. Kendra works actually out of one of our other offices. I, of course, am out of Wisconsin. I'm the Associate Vice President of Investment Services here in Wisconsin. I've been with PMA for about 7 years. Kendra is one of our newer faces, but she is very experienced in the field, and she's going to kind of share with us a bit more information, I think, that you had alluded to. Real quick, sort of the lineup for today. Here are the topics we're going to kind of cover. We're gonna go over an economic update. Sort of the higher for longer mantra has been something that we've been discussing now for, I'd say, probably 3 to 4 months. And it's also kind of brought up some fears of a potential recession. People are asking, how do we land? How do we land softly, I guess, is a better way to ask it. But that being said, there are still many opportunities out there for small and large districts alike. So we'll talk a little bit about the lucrative investment landscape, any changes to best practices, and matching investments with some of the liabilities. Again, real quick, I don't need to dive too far into this, but PMA, we've been serving public sector clients for 35 years. We've got 3 separate companies that we use to service our clients in a wide variety of ways. We have about 160 employees kind of scattered throughout the United States. Predominantly, we are in Wisconsin, Minnesota, and Illinois. As a whole, PMA has $43.2 billion in assets under administration as of the end of September. 26 billion of that is advisory assets under management. So that would be sort of the separately managed accounts that some of the larger entities might have with our investment advisory group that Kendra works with. And that is also going to be the pool, the LGIP pools that we manage for various states. So I guess with that, I thought we had a transition slide in here. I guess we don't. I'm gonna kick it right over to Kendra first. She's gonna give us a little bit of a market update before we kind of get into some of the more investment related topics. Kendra?
Thank you, Matt. Good afternoon, everyone. Again, I'm Kendra Shelland. I've been with PMA for about 2 years now. Prior to that, I spent 12 years out in New York working in fixed income sales, specifically securitized products or mortgage-backed securities. Originally from the Minneapolis area and came back to Minneapolis about 2 years ago and have really enjoyed my time with PMA ever since. So thank you very much for letting me be here today. But with that, we'll talk a little bit about what's going on in the economy and in the markets before passing it back to Matt. So starting with the Fed, which has been a topic of conversation for over a year now, and I'm sure everyone is very tired of hearing from them. But as always, there are changes going on with the way that with information coming out of their meetings. The most recent Fed meeting was in September. We will hear from them again tomorrow. Coming out of the September meeting, most notably what we heard was a flat rate move. So they didn't increase rates at the September meeting. But again, more notably, what they did is they did shift economic projections upwards, or basically tell the markets that their GDP expectations are even higher. Now, -2 quarters of negative GDP historically have been deemed a recession. So by moving these indicators upwards, they're basically indicating that they feel that they are moving towards their target of kind of a soft landing or bumpy landing, if you will, versus a hard landing where we would see a recession. Now, in addition to that, another kind of shift in policy that we saw come out of the September meeting was this focus on higher for longer in rates. Now, when I say shift, they have been saying this, but historically they've been saying rates are going to remain higher for longer, and we will keep raising rates as long as it takes to bring inflation down. The little change or little slight shift that we saw come out of the September meeting was basically that they're really focusing on this higher for longer mentality in terms of bringing inflation down. They are seeing inflation start to tick down, and it's going in the direction that they would like, albeit it's still higher than where they want it to end up. They feel that they are moving towards there. And so keeping rates higher for longer will help continue that downward trajectory in inflation, while maybe not having to raise the front end as much as they have, especially in 2022, but even as much as markets may have anticipated prior to this meeting. So on the right-hand side of the screen here is a snapshot from Bloomberg, just showing us the expectations or the market's expectations of rate hikes going into the November meeting, which is tomorrow already. And as we can see, they're actually very low. Prior to this, we were seeing more 50%, 75% that we would see a rate hike in 2023 or another 25 basis points. At this point, the market has pretty much priced it 25% or lower to see any sort of rate hike in the next two meetings before 2023. And more notably, in 2024, the market is actually expecting the Fed to start to cut rates. Now, the Fed saying higher for longer does not necessarily mean that we will stay at 5+% interest rates forever, but higher for longer being higher than the 0% interest rate environment we saw really following the GFC up until this rate hiking cycle. So trying to find that happy medium of where rates should end up is really being reflected or was really pushed by the Fed in the September meeting. And if we move to the next slide, we can talk about how the markets finally started capitulating to this idea as well. So starting with our Treasury curve, as we've looked at this slide, we've looked at where Treasury the yield curve has been. We have seen this kind of hill at the front end of the curve, and that's really been reflecting what the Fed has been doing in 2022 as it continuously increases rates, as we now see money market rates above 5%. But as we show kind of this green, this parallel shift upwards out the yield curve, these are the longer Treasury rates that we're seeing. And throughout these past couple months, we've really seen that part of the curve move higher, just the market reflecting that it's believing what the Fed is saying, that it's going to keep rates higher for longer. Now, in addition to that, the market's really reflecting these higher rates as a result of that increase in economic projections versus an increase in inflation. And so what we're showing here as well is throughout 2022, we saw rates rise on the basis that inflation was quite elevated. And when we say real rates, or this green line that we're showing, it's really rates taking inflation out of the equation and showing that rates are actually moving up on this higher economic projections versus higher inflation numbers. Now, the Fed walks a fine line, as these real rates will put pressure on inflation down and will also put pressure on GDP. And again, the Fed's goal is to bring inflation down while keeping GDP positive and out of a recession, and that'd be the soft landing they're really aiming for. So digging a little bit deeper into inflation, as that has been really the Fed's focus for the past year and a half, I'm actually going to start on the bottom of the slide here. The global map is really pretty, but I think comes better after talking about CPI, as I know CPI is a very strong indicator and a very helpful indicator for a lot of entities. So the Fed has really moved from focusing on what we call headline CPI number to a core CPI number. And we want to dig into why that is. Now, the past few months, we did start to see headline CPI start to creep back up from that downward trajectory we had been seeing since mid-2022, and why that was happening. Now, they've created another element of CPI called core CPI, which strips out energy as well as food, as these are rather volatile elements of inflation prints. And because of that volatility, the Fed doesn't feel that they're necessarily, trend in direction with the overall market basket that they want to see from CPI. And so if we take those two elements out, we look at core CPI, it continues that downward trajectory that the Fed really wants to see. And if we put oil overlay across that, we can see that spike in oil prices is really what helped pull headline CPI up, and why the Fed wants to focus on core CPI and not just move necessarily with the energy market. Now, why not move with the energy market? We showed oil production by country. Now, the US has started producing more oil inside its borders, but oil is still a global commodity, meaning even if we start to produce more, we can influence the price down, but the price is still set from a global market. And so with prices going up, that is definitely still going to pull CPI up, but maybe not something that's as an indication of trend and direction of where inflation is going. So something the Fed wants to monitor, but not necessarily something it wants to focus on from an inflation perspective. So how can we translate this into our global economy, or the US GDP more specifically, if we start to look at imports by country and how companies are really reacting to the pandemic that we saw? Now, there's a lot of supply chain issues that pushed inflation high in 2022. So one thing we wanted to dig down into is, could that happen again? Will we see that happen again? And how is that influencing inflation? And what we're seeing is companies are starting to really diversify their supply chains. Now, we've seen Mexico and at some points Canada overtake China as our main importer into the US. And what that means is companies, just as we would diversify a portfolio, they're diversifying their supply chains to really avoid any sort of economic downturn due to those supply chain constraints. So basically learning from some of the mistakes that we saw in 2022 and hoping to not see those again, despite some of the geopolitical environments that we're seeing. So with inflation, the Fed still feels that trend and direction is coming in the right direction. And that higher for longer will continue to influence that to move in that direction, versus maybe moving just the front end of the curve, continuing to move up. So kind of a shift in policy with the same goal in mind.
Kendra, quick question for you. The US imports by country, is that a percentage of the total, the unit?
Those are actually millions of dollars.
I see. Okay, thank you.
Those are outright dollars. Yes, I apologize. We added, those got cut off and we re-added those back, and it didn't quite make it into this final deck, but yes.
Okay, no worries. Okay.
So those are millions of dollars, but our oil production is in barrels. So there is a slight difference there. So moving into kind of what this means for investing, and I think this will tie really great into what Matt has to talk about. We're looking at our 2-year rate versus our effective Fed funds rate. And what we're seeing here is that they've inverted, or basically investing in a longer term security is going to pay you less than a shorter term security, which is an abnormal curve, or not a normal investment environment, as we would call it. And we've shown that throughout history, or throughout the past 20 years of history, as this investment environment is actually better than we have seen in the past 20 years. But really wanted to highlight how these two curves do move together. So the market does price on anticipated rate moves. And so when we start to see these lines kind of invert like this, it means the market is anticipating that money market rate, or that the Fed is going to cut, and money market rates are going to come back down to where that 2-year level is, right? The Fed is always trying to price that to perfection. And so I thought it was a really great illustration to show why the 2-year might be a lower yield than your money market yield. And that's because the market is basically saying, as you reinvest money market, you're still going to end up at the same yield as that 2-year, basically saying they expect the Fed to cut within that time frame. Now, on the right-hand side, we're really looking at what this looks like from a total return perspective. And what we wanted to show here is our income return, or something that we really haven't seen, like I said, in almost 20 years, is an income return, or, think about it more like a coupon. As you're investing at these 5% levels and investing at a 2-year treasury, that's not something we've seen in so long. And you can see how it really influences that total return as you start to go out into maturity. Now, again, this is a really great time to invest, and that's really what this is trying to show. So what all of this means from the Fed is that it is a great time to be in the markets. So we always say time in the market is better than timing the market. I don't know when the Fed is going to cut. They don't know. They're going to be data dependent, as they always have been. But the markets are expecting it to be within the next 2 years and don't expect the front end to move that much higher. And so when we're looking at that from investment perspective, it does look like a very good time to invest. So I'll just finish with a couple outlook thoughts. The Federal Reserve is stating higher for longer, and markets are capitulating to this idea. We do see our economic outlook improving, but that is with persistent inflation that has not quite reached that 2%, causing that the Fed to keep those rates higher for longer. Those higher real rates, or this real rate move up, despite inflation, will start to slow inflation, but that is going to create growth headwinds and really cause the Fed to walk that fine line of bringing inflation down while keeping GDP positive, and why they're going to be data dependent going forward in all of these future meetings. Now, we will have domestic and international risks in focus. We do have an election cycle coming up. We do have conflicts around the world. All of these will contribute to increased volatility, as well as where we are in this point in the rate hiking cycle. We tend to see higher volatility as we tend to reach the end or near the end of this rate hiking cycle as the Fed starts to shift its focus. All of that, we still expect returns to be positive or better than 2022 and 2023 in nearly all asset classes, after seeing negative returns for multiple quarters in a row in 2022. So with that, I will pass it back to Matt and pause for any questions.
Yeah, could we pause just there for a minute? You talked about earlier the Fed trying to identify a smooth landing or like a little bit of a bumpy landing. The variables that are important vis-a-vis that landing, so to speak, are inflation and GDP, and maybe you could just talk about what that means, because we had this big recession threat. We had a lot of money being injected into the economy through the COVID funding and all that stuff. Just explain that a little bit more, if you would, Kendra.
Absolutely. So in 2022, one thing we talked about a lot was basically this rising inflation, but with a strong consumer. And so the Fed was really looking at strong employment when pointing at a strong consumer. And so when we think about a recession, we think about how this is all going to affect the consumer, right? How these tools that the Fed is using filters down into the economy. And so they want to, it is to protect the consumer that they want to bring inflation down, but at the same point, they don't want to harm them. And so we've historically looked at employment. Those have really remained strong throughout 2022. We're still seeing strong consumer prints in terms of consumer spending and other metrics that they're looking at from the consumer's perspective. Now, if the consumer starts to step back, what that will do is cause growth to slow down or go negative, which is where we would see some sort of recession risk. And so what the Fed is constantly monitoring this data to try to bring inflation down to help the consumer without hurting them to a point where they would see maybe employment go up. We've looked a lot at job openings. Now, if anybody's tried to hire in the past 6 to 12 months, it's very challenging, just showing that the labor market is still extremely strong. And so a lot of people will point to the inability to have a recession with such a strong labor market, which has really helped push the Fed to look at those GDP projections and move them upwards. Now, at this point, they're starting to look at how long these real rates will take to kind of trickle down into the consumer, and if they're able to really move rates to a certain point that doesn't send the consumer into some sort of recessionary period or start to contract our GDP at all. And so it's kind of this circle of how it affects everything. Now, as inflation goes up, you would expect wages to go up. That is an element of inflation. So as wages are going up and increasing inflation, that albeit is good for the consumer, that's also raising inflation. And so the Fed is kind of trying to move all of these pieces around by using the Fed funds rate to equalize and normalize all of these pieces. But all of that with a positive economy, because the last thing they want to see is be sending the economy into some sort of recessionary period where we would expect job losses to happen and other kind of negative effects of a recession to come through.
So we've got the Fed setting the prime rate. We're getting inflation under control. Wages are strong. Employment is strong. We've got still this inverted yield curve, which we've talked about in the past as well, leading to Matt, where you're going to be able to say, hey, this is a great time to invest, and here's what that would look like.
Exactly.
Okay. Any other questions from other folks on the call this afternoon? can unmute or do your video. It almost feels like you're speaking a little different language. So I really have to, and I took a year of economics in college. I was like, I'm tuned in for this, but it's hard. It's complicated stuff, and it's really interesting to hear somebody so fluent with it. So I appreciate it.
Oh, thank you very much. Thank you for having me. And I'm always happy with follow-up questions if anybody has any as well. So
Cool. All right, Matt, what you got?
Yeah, thank you, Kendra. You always do such a wonderful job with the economic component of this all. Now, when it comes down to the practicality and the day-to-day operations of a school district, that is more my role, where I step in and I'm able to assist these districts in capitalizing on some of these opportunities that are in the market. First and foremost, we can't emphasize enough the three main themes that we consistently discuss with our clients, and that is safety, liquidity, and yield. Safety, of course, first. You want to make sure that if you have the ability to get some collateralization or some insurance on the deposits and investments that you have, that you're able to do so. Preservation of capital is paramount. Liquidity, obviously, you need to meet your liabilities throughout the year, and you don't ever want to. Of course, many districts in Wisconsin cannot meet their liabilities throughout the year, and for that we have some short-term borrowing. But if at all possible, you don't want to tie your own hands by overextending yourself. But yield, it's very important, but only if you are able to sustain the safety and liquidity themes first. And we do that with a number of different types of investments. All of these are going to be state statute allowable investments, some of which we do provide on a standalone basis to our clients, and some of which we only utilize within our local government investment pools. Predominantly, I would say between 18 months and probably about 9 to 10 months ago, U.S. Treasuries were driving the market. The Fed was hiking rates. And we saw the benefit of those rate hikes in the U.S. Treasuries. CDs were a little bit of a lagging concept at that point in time. As of today, however, I mean, you are certainly able to be out in the markets getting bids on those insured deposits that are going to be beating some of the treasuries and government agencies that you'll be finding. And of course, you know, the yields within our local government investment pools are still very strong. We would anticipate that they follow the Fed hike, or the Fed hikes and the Fed easing rates very closely. The duration on those portfolios is around 7 to 10 days, which means that within 7 to 10 days of any changes at the Fed level, you'll likely see all the changes within those yields that you will see until the next time that there are changes made. And then we've got the repurchase agreements, municipal bonds, commercial paper. These are some of the securities that we don't necessarily offer on the standalone basis. We can, but we always like to make sure that it's on a more managed approach. And that's because some of these debts are not necessarily taxpayer debts. These are corporate debts, and therefore are just slightly further down the risk curve than we feel a bit comfortable with. But the yields are certainly there. They're provided through these types of investments. And so we utilize them within our pools, where we're able to distribute that risk amongst all the participants in the pool. And therefore also provide you guys with a bit more bump in yield. These are some of the indicative rates that we've seen throughout the market. Obviously, these rates are as of late last week. You can still see that some of the $250,000 portions of CDs are going to be driving some of these markets. You are going to still be seeing good yields from the U.S. government, Treasury and government agency investments as well. It's more or less flat, but you can definitely see that once you get past a year, those rates definitely are going to begin dropping, just like Kendra had said. And our recommendation is that if you have the ability to extend yourself out over that drop in yield, that we absolutely do so for you. And, you know, we can provide all the bids that you'd like. My job and our job, I guess, at PMA really is just to provide all of the information to participants and clients that we can, so that they're able to make the decisions that are best for them in their school district. And if anybody does have any questions about this, just feel free to jump in. Let me know. But one of the things that I wanted to highlight was the idea of investing with a plan. That's always been sort of one of the mottos here at PMA. It's optimize your investments, build out a plan that's going to allow you to identify those opportunities, so that you know when you have liabilities that need to be met, you have the liquidity necessary. But for every day in between, you're going to be capitalizing on the yields that this market is providing to you. And so one of the ways that we've been working with many smaller school districts, especially in the state, just because they aren't necessarily provided with the same level of service or the same number of personnel that you might see at a larger school district, is the idea of a cash flow analysis. And so part of this analysis is a collection of data from the school district. It's usually historical data, statements, stuff like that, and future budgetary data that we will put together in an analysis that will provide a district with a roadmap, so to speak, of where they are going for the next fiscal year. Many districts are used to working on an accrual basis. We work on a cash basis, saying, hey, you have this cash in your account for the foreseeable future. So let us build out this plan for you. Let us show you exactly when this money needs to be paid out from your account. We'll work with them to kind of analyze it on an annualized basis, looking at the month-to-month balances, revenues and expenditures. But then we'll also break it down and begin working with districts on a weekly basis, saying, okay, so state aid arrives, December, the first Monday of the month. That's typically the low point for many school districts. After that, many districts are allowed to sort of extend themselves out, maybe a little bit more further down the yield curve and take advantage of some of these rates. This is what it looks like from your perspective. You can invest maybe X number of dollars for 75 days, and you can invest X number of dollars for 112 days. And then at that point, that money matures and it becomes fully liquid and available to you for things like payroll. Let's say if you have a large one-time project you're planning for, and you know that that's going to occur on a specific month of the year, we're able to plan for that and bid out investments and make sure that you are earning money, but also able to pay those liabilities throughout time. And so that's really what we wanted to impart upon you guys today. With that, I guess I can kind of turn it back over to John, and if there's any questions, we're happy to answer them. And we really appreciate you guys allowing us to come in here today and just kind of talk a little bit about where the markets are at, the opportunities that are afforded to you, and how we have been helping people identify those opportunities within their own books.
Yeah, thank you, Matt. I was just reflecting as you were talking about the cash flow analysis. It was last March that we did a cash flow analysis and investing workshop with you, which is available on our YouTube channel. Today's session will also be on our YouTube channel. We also have from you, we have the sample investment policy. So we have a couple examples on the on the Google Drive that's affiliated with our YouTube channel, so people can check out those policies. It's a neat idea. It's funny. It was news to me, and I had heard it before when I became a superintendent, but then it was that much more obvious. Like, it's not like getting a regular paycheck. You get a big chunk of money 3-4 times a year, and then your cash flow, your needs are relatively constant. Obviously, your payroll is going to be relatively constant month to month, but like you said, certain projects, fuel costs, whatever things that you may be planning for differently based throughout the year, but then why not put that money to work? And we just had a very positive experience with that. Obviously, with PMA, when I was a superintendent, that was a lot of fun to be able to work with you guys and make money on our money and then do more good things for kids. It was pretty fun.
Yeah, and one of the things that we're coming across, and I'm going to be coming into my 8th year now at PMA, so having been through a number of those cycles and provided cash flows for a number of districts, just for 8 years in a row, sometimes updating it more than once a year. I think one of the things that's really stuck out with me lately is that those low points have been changing, just with the changes that we've seen from the state budgets. And so it's really important just to keep those updated. And it's really important to make sure that you're always aligned with your personnel and where you guys stand from a fiscal year moving into the next fiscal year, because if you guys get to a point where you don't have the cash necessary, that can be really tight moments, and so it's always just important to have a plan in place and make sure that you guys are able to identify them further out on the horizon than it's comfortable. So
yeah, sounds good. Well, any other questions out there from anybody who's attending? I don't know if you want to stop sharing your screen, Matt. We can probably get a larger view of anybody who chimes in here. Not seeing, and we don't appear to have a chat function. Well, with that, I think we can close out today. Great half an hour of information about the economy and global trends and oil prices and all that good stuff, and then how to help our school districts invest. Appreciate it a lot. Thank you, Matt. Thank you both for your time today. And folks can see the session on our YouTube channel, and we'll see you again next time for our next market update in about 6 months.
Thank you, John.
I'll stop the recording and then just be interested in chatting a little more.